Dhoot Transmission is preparing for a massive public offering. With an issue size of 3,066 crore rupees, it demands serious analytical scrutiny. This company builds the electrical nervous systems for vehicles. They manufacture the wiring harnesses, sensors, and controllers, routing power through modern engines. This split-screen visualization illustrates the scale of this offering. The left plots historical revenue growth, while the right frames the 3,066 crore IPO against their market dominance. They command a 37.58% share in Indian two-wheeler wiring harnesses and over 70% for three-wheelers. To evaluate this massive valuation, institutional investors must look past the top-line revenue numbers and examine the underlying capital mechanics driving the operation. The core question is whether their aggressive physical expansion is yielding proportionate returns, or if profit margins are being sacrificed simply to capture market share. We will evaluate this by analyzing three distinct vectors. The first is revenue quality. The second is capital efficiency, measuring how effectively they deploy physical assets. And the third is their pre-IPO capital structure, assessing the health of their balance sheet. Dissecting the relationship between these three pillars allows us to model the true post-IPO value of the firm. This graph plots total revenue against profit after tax from 2024 to 2026. The top line expands 61%, climbing from 2,797 to 4,525 crore rupees. Profit after tax grows from 298.75 to 396.84 crores. The gap reveals a flat profit margin despite massive revenue growth. This data indicates a volume-driven scaling model. The company is successfully capturing market share, but they are not currently expanding their per-unit pricing power. To understand why volume is accelerating so quickly, we have to look at the transition happening across the automotive sector. This area chart tracks Dhoot's exposure to the electric vehicle sector. Over 3 years, the proportion of their revenue tied directly to EV products expanded from 16.19% to 24.18%. This growth is driven by specific component lines required for electrification, including dedicated battery packs and specialized electronic controllers. These new product categories are scaling rapidly, alongside the traditional internal combustion engine components that still form the base of their daily operations. By fiscal year 2026, they achieved an EBITDA margin of 15.71%, while their final profit after tax margin settled at 8.70%. Dhoot executes a high-volume market capture strategy via the EV pivot. They prioritize absolute scale and component distribution over margin expansion in the short term. Moving from revenue generation, we must examine the physical capital required to sustain this output. This map outlines Dhoot's infrastructure. They manage 23 active manufacturing units across India and international locations, with 2 more heavy manufacturing plants under construction. Supporting this footprint are 3 dedicated design and engineering centers, powered by a research and development team that has grown to 237 employees. Automotive component manufacturing is inherently capital-intensive. It requires constant investment in raw materials, prototyping and tooling, and final assembly lines. This grid isolates key performance indicators, measuring how successfully management deploys capital. Return on capital employed stands at 19.14%, measuring operating profit generated from every invested rupee. Moving right, they report a return on equity of 16.30% and return on net worth of 16.55%. These are strong yields, especially when contextualized against the massive capital drain of continuously building new manufacturing facilities. Management has proven effective at translating heavy physical asset expansion into actual near 20% equity returns. To understand how these 23 manufacturing assets are funded, we must inspect the balance sheet. This balance scale represents their pre-IPO capital structure, revealing a conservative debt-to-equity ratio of exactly 0.35. If the company already maintains low debt and generates high returns on capital, why do they need to inject over 3,000 crores of public equity? The answer lies in the specific capital allocation plan detailed in their prospectus. This Sankey diagram maps the 3,066 crore rupee injection. First, 464.80 crores is allocated to repay the company's direct borrowings. Another 301.77 crores retires debt held by subsidiaries, including UK operations. Compare this massive reduction against the 150 crore allocation for building new plants. Management is dedicating roughly 766 crores to deleverage a balance sheet that is already mathematically stable. Extinguishing this debt will drastically reduce their ongoing interest expenses. This creates a structural mechanism to widen their 8.70% profit margin without requiring them to increase product prices in a highly competitive market. This dashboard unifies our three analytical pillars to give us a complete view of Dhoot's financial architecture. The first pillar confirms the successful execution of a high-volume, EV-driven market capture strategy, yielding massive top-line revenue. The second pillar shows their proven ability to generate 19% returns on capital employed, despite managing a vast physical manufacturing network. The third pillar reveals an upcoming balance sheet optimization, utilizing IPO proceeds for massive debt retirement rather than just physical expansion. The capital influx from this offering allows them to connect their historical top-line momentum directly to future bottom-line profitability. Their revenue floor during this transition is secured by long-term corporate contracts. Their top 5 customers maintain an average relationship of 13 years with the firm. Institutional investors will be monitoring the upcoming quarterly reports to see exactly how quickly the reduced interest expenses impact net profit. The issue closes on August 12, 2026, with tentative listing scheduled for the 17th. The data points to a highly calculated structural shift. This IPO operates as a mathematical engineering tool. It is designed to convert existing top-line EV momentum into much stronger bottom-line yields.